Hello, I'm Darren Madden, Client Portfolio Manager with the Emerging Market Debt team at Lazard Asset Management. Thank you for joining our Insights webinar. Today's session will focus on sovereign defaults in emerging markets. Common perception tends to be that emerging market defaults are somewhat frequent and result in large investor losses. In reality, the empirical evidence shows otherwise, as we will see through our examination of past defaults in EM. We will also discuss some of the risks and opportunities from restructurings in today's market. The media has given a lot of attention to the potential for a looming debt crisis in emerging markets. The narrative is basically that EM countries have accumulated vast sums of debt in recent years and now, faced with a huge economic shock as a result of the COVID-19 health crisis, will need to restructure their debt burden. While it's true that EM countries have taken on more debt in recent years as borrowing costs have hovered near all-time lows, the reality is that emerging markets in general came into the crisis on relatively strong footing with debt-to-GDP ratios of around 50% on average. In contrast, developed market countries have been on much more of a debt binge, with debt-to-GDP ratios in the triple digits in countries like the US, China, and Japan. Importantly, much of the debt owed by middle-income EM countries is denominated in local currencies. While defaults on local currency debt are not unheard of, they tend to be quite rare. It is also true that the pandemic is a major shock for the global economy and will certainly impact emerging markets. However, the strengths and vulnerabilities differ greatly across the investment universe. Needless to say, all economies will experience a significant drop in growth and deterioration in fiscal deficits. But the higher grade countries are in a solid position to weather the crisis. Common traits among these countries are resilient balance sheets, strong institutional frameworks, room for policy maneuverability, ample reserves, and access to financing. That said, there are a handful of countries where default risk is heightened. We will walk through some of these situations shortly, but the bottom line is that it is highly unlikely that EM will be engulfed in a broad-based debt crisis. Instead, the key for investors in navigating this challenging period is to understand the strengths and vulnerabilities of the 70-plus countries in this diverse investment universe. We have conducted a number of default studies over the years, and the reality is that sovereign defaults are quite rare and typically represent a significant alpha opportunity for long-term investors. Since 2000, there have been a total of 14 defaults, less than one per year among index constituents. Several of these defaults have been by smaller countries, thus the average annual default rate has been around 0.7%. Upon closer examination, we have found that there are two primary triggers for defaults. First, unfavorable global financial conditions can drag down an already fundamentally weak country. Examples in this category include Argentina's 2001 default, when poor fiscal management and an unsustainable exchange rate policy were exacerbated by a drop in commodity prices and a devaluation of the Brazilian real, Argentina's main trading partner. In monitoring a country's economic fundamentals, clues to an imminent default may include debt-to-GDP ratios greater than 60%, short-term debt to reserves greater than 130%, inflation above 10%, or high political uncertainty. The second trigger for default tends to occur when idiosyncratic factors tip a deteriorating country past the brink. An example here would be Ukraine in 2015, when Russia's incursion of Crimea pushed Ukraine into default. Thus, there are key commonalities that investors can use to identify potential default candidates. We also note that default rates in EM tend to be much lower than US high yield. While we expect to see an increase in EM defaults in 2020, our default rate forecast is relatively muted at around 3%, and most of these defaults have already occurred or are priced into the market. In contrast, defaults in US high yield are expected to reach the high single digits this year due to significant exposure to troubled sectors including shale oil production, retail, and travel and hospitality. When defaults do occur, recovery values are essentially a function of two factors. The primary determinant is the sovereign's ability to pay, and to a lesser extent, recovery value can be influenced either positively or negatively by the restructuring negotiation between creditors and the sovereign. Simply stated, due to the lack of a formal liquidation process for sovereigns and the interplay of large multilaterals like the IMF, investors have often been rewarded significantly through sovereign restructurings. Negotiations typically involve a degree of game theory, with each side trying to maximize their outcome by calibrating the other side's priorities and alternatives to a swift agreement. The basic structure is that creditors agree to restructure or write off a portion of the creditor's debt to help the issuer reach a sustainable debt load. The debt restructuring may take a number of forms, including principal haircut, coupon deferment or reduction, maturity extension, or GDP warrants. Due to the severe economic contraction that typically forestalls a default, data typically improves following a restructuring due to favorable base effects and a reduced debt burden, which allow a country to focus on fiscal discipline and economic growth. While each default is unique and warrants a detailed bottom-up analysis, we have developed a general framework to help model expected recovery values. The default spectrum ranges from a debt reprofiling, which is the most creditor-friendly outcome, to a hard default in which the two sides engage in a protracted standoff. In general, countries facing a liquidity issue tend to have higher recovery values as the focus of negotiations centers around the country's short-term financing needs and providing a runway to enable the country to service its debt. This can usually be achieved by extending maturities along with some modification to coupon payments. It is also worth noting that restructurings tend to happen faster today than in the past. More often, preemptive negotiations have helped both sides achieve more favorable outcomes. Additionally, more countries now include collective action clauses in their bond offerings, which allow debt negotiations to be concluded with the approval of 75% of bondholders. These clauses allow creditors to coordinate their demands, resulting in fewer holdouts and swifter negotiations. Thus, many restructurings are resolved in less than 6 months. A case in point is Argentina, which officially fell back into default in May, but looks increasingly likely that a resolution is imminent. The key question for investors is whether the attractive valuations in EMD today represent a compelling investment opportunity or are reflective of an onslaught of future defaults. As shown in the table at the top, current index level spreads of 515 basis points imply a 5-year cumulative default rate of 28%, assuming a conservative 20% recovery value. This translates to a roughly 6% annual default rate, which is twice our base case expectation of 3% for 2020, and is well above the historical average of less than 1%. Indeed, there are a handful of countries with elevated default risk due to weaker institutions, heavy dependence on commodity exports, limited access to financing, and a high dependence on tourism and remittances. But by and large, these countries are priced accordingly and constitute a very small portion of the overall investment universe. Just as the Fed and the ECB serve as the lender of last resort in developed markets, the IMF is the lender of last resort in EM. Importantly, the IMF has responded with short-term financing facilities to help countries meet short-term liquidity needs with few concessions, an important backstop to navigating the current crisis. Lastly, we would like to briefly discuss some of the restructuring opportunities we see today from Argentina to Zambia. Simply put, we believe some of the best alpha opportunities in EM today are in restructurings. Bond prices tend to bottom at or near the default date, and investors willing to take a medium-term view tend to be rewarded handsomely. This is very much the case today, as we see potential returns in the range of 25 to 100% across defaulted names, with the exception of Zambia. Each situation is unique. The timelines will vary significantly, and each situation comes with its own set of risks. But we believe investors are more than adequately compensated for these risks based on current valuations. As discussed, we expect Argentina and bondholders to reach a mutually beneficial agreement in the near term. Interestingly, bondholders may receive warrants linked to agriculture prices. We've seen GDP warrants and oil warrants in the past, but this would represent the first time that agricultural warrants have been part of a restructuring agreement. In contrast, Venezuela has been in default since late 2017, but is home to the largest oil reserves in the world. The key to unlocking this value will be regime change, and while it is tough to envision a near-term catalyst for Maduro losing his grip on power, We believe his removal is inevitable given the dire state of the economy. In summary, we do not believe a debt crisis is looming in emerging markets. We're likely to see a few countries need to restructure their debt obligations, but these events are often attractive return opportunities for long-term investors. Thank you for joining our webinar. Above all, we wish good health and safety to all of our clients and listeners.